Kris,
How you doing?
I'm great.
Good.
That you can hear me, I can hear you. We're recording, but I'll edit this if we need to. So let me pause it here. Okay. So today I've got Kris Heron on the show, and I'm very excited to have him. We've known each other for I don't know how long now, but probably 15 years, I think.
Yeah.
So welcome, Kris. And I thought first, probably just to give people kind of like a little bit of a behind the scenes of who Kris is. Can you maybe just share, maybe a little bit about who you are, what you do right now, and then we'll kind of jump into the, the reason why probably most people are tuning in, which is to understand how to finance a commercial deal. So
Yeah. So I guess the background is, so I'm a partner and founder of Miller Foreign. We're a commercial mortgage brokerage based in Calgary. Our focus is Western Canada. There's a team of 6 of us, and we work on everything from, small properties to portfolios. Our clients would range from, individual private buyer owner, developer, real estate investment trust, pension fund, partnerships, the whole sort of, I think, spectrum in terms of who owns or manages and buys real estate. So we've got a pretty diverse group of clients. And, we work a little bit differently. A brokerage has the connotation of an entity with a bunch of individuals that do sort of their own work, their own files.
yeah,
We've always had a team approach. So we've broken down the mortgage process or the structuring mortgage debt
yes,
into certain steps. And of the 6 of us, everybody plays a different role within that process.
right,
So when a client calls in and says, I need to find out about our deal or what's going on, you generally can speak to anybody,
yes,
not just a particular, individual. We think that works well for our clients. We think it's structured well for our group, and it works well for lenders. So it's a little bit different. I don't think I'm sure other people do it, but it does. We're not a typical brokerage, I guess, in that fashion.
yeah. And I want to. I think for people that are maybe new to commercial real estate, they may not even understand the difference of like commercial brokers finding the financing and then the actual lenders, because you're really the intermediary between the bank that's actually going to give the money and you're representing the client who's looking to get it. And so you're essentially shopping their deal around to get them the best terms and rates. Or, I don't want to put words in your mouth. So
yeah, no, that's right. There's probably 2 misconceptions. We are definitely an intermediary. We are hired work on behalf of and get paid only by the client.
yes,
And one of the things that we often see when you think of a mortgage broker,
yes,
everybody thinks of a residential broker. That's more of a commodity.
yes,
And residential brokers get paid by a lender. And the other thing you brought up is we don't have our own money, so we're not placing debt on a property. We're just an intermediary, so we don't have any conflicts in that regard. We don't have a fund where we're lending, and so we go to lenders in the market, and so that would be banks, life insurance companies, pension funds, credit unions, and we're using their money. We're structure the debt, and they're placing the money. So we work in between the client and the lender,
yes,
and structure that mortgage. Yeah.
Well, why don't we? Because I mean, even for myself and for anyone listening, like Kris and I have worked on deals together. I mean, I think we met back when I was at Sun Life as a commercial, so I represented the pension fund that actually lent out the money.
Yeah.
But I mean, what you guys do is just really interesting. And I think people would probably get a benefit of almost like a timeline when, let's say I found a property I want to purchase it. When do they contact you? What are the steps? What are the kind of maybe some costs associated with it? Maybe just kind of walk us through what a typical deal, not the crazy ones that you and I have worked on, but more of a typical deal.
Yeah, if there's such a thing as a typical deal today. But
Not true.
I think so. There's two ways to approach that question. One is from the borrower side,
Yeah.
which is when should you get a mortgage broker involved?
Yes.
And I think my view is, holistically, if you're looking at acquiring a property, you probably want to have your team in place before you start looking at property, certainly before you put an offer in.
Yeah.
And that's not just, a brokerage. That's, you as a person that's finding the property for them, your legal team, all of those things should be in place.
Mm-hmm.
Even your ownership structure, which we've seen before. Somebody says, I want to buy a property, but they don't know how they're going to own it.
Mm-hmm.
So all those things I think should be in place. But once you've got that, assume we've got all that settled. If you're looking, for a client of yours, Shane, if you've brought them a listing and said, here's a good property, we should look at it.
Mm-hmm.
That's a perfect time to get a commercial mortgage broker involved.
Right.
We're highly confidential. We've been through this many, many times. So it's easy for us to, look at it, at the property, underwrite it and say, okay, you're looking at it from an equity perspective. Here's how the debt market would look at it.
Yeah.
So I would advocate that, as soon as possible, because then the conversation shifts to, okay, well, you're the borrower, you want to buy this. What are your needs? I can tell you what I think the market can do, but it's important to understand what your needs are.
Mm-hmm.
So if the borrower is saying, well, I'm happy to put in a lot of equity, but I need the best rate. That's a lot different from somebody that says, I don't have a lot of equity. I'm not necessarily rate sensitive.
Yeah.
Or, guarantees are really important. So every deal is so individual. I think it's best, and this isn't just about the mortgage side.
Yeah.
I think it's best not to make assumptions what's going to happen or what you can get.
Yeah.
I think it's better to get those things, at least feedback or educated guesses on as much as you can up front.
Yeah, I agree. So let's say I've got a team, and let's just take me as an investor, right? Because as you know, I'm buying properties, and so I've got my team in place. I've got a letter of intent. I go to a purchase and sale agreement. I come and I sit down with you, Kris, and I say, hey, here's the deal that I've got. Maybe it's a retail property. Maybe it's got a little bit of vacancy. We sit down. I tell you, for me, I'm okay to put 30% down on the property, right? 30 to 35%, somewhere in that range. I like to get as aggressive a rates or lower rates as possible. Am I most likely going to have to put up personal guarantees or corporate guarantees if I'm putting 30 to 35% equity, or maybe partial guarantees?
That's really going to depend on a lot of factors. So at 65 to 70% loan to value, it's really then digging into, well, do you have an anchor tenant that provides 70% of the net income, and do they still have 15 years left on their lease?
Yeah.
Or I think there's so many factors in determining the guarantee side of it, which is hugely important for any investor.
Yeah.
I think it's safe to say that in this market, at least for Alberta, where we are right now, in the economic cycle, non-recourse financing is very, very difficult to find.
Right. And non-recourse is no guarantees.
No guarantee.
Yeah.
So if you're approaching it, you're saying, I don't have a guarantee, or I won't provide a guarantee, whether it's personal or corporate.
Yeah.
You have to be really, I think, probably looking at a higher quality asset.
Yes.
You can't be in this, I'm sure not everybody listening is, maybe keenly aware of the office market in Alberta. You're not buying office and getting non-recourse or, financing without a guarantee.
Yes.
And then I think you have to adjust your assessment of equity.
Yeah.
So I would say arguably past 50% loan to value, it's going to be much more difficult to find a lender that says, I like the property, I like everything about it,
yes,
and I'm happy to have it stand on its own.
Yeah.
I think then that brings in, for lenders that look at non-recourse, that brings in experience too.
Sure.
Do you have other properties like this? Have you managed them?
Yes.
Or do you have a third-party professional manager?
Yeah.
Do you have the financial wherewithal to, bring in and pay for TIs and leasing commissions if a tenant leaves?
Yeah.
So it's definitely, I know it's a big question, not an easy one to answer. It's very, very deal specific.
And that's one of the things, like as a consultant or when I'm coaching people looking to invest in commercial real estate, one of the things I talk about is, and I didn't even do it intentionally, which was to kind of ask a big question, because as soon as you started to say it, I realized that there's so many variables in terms of location, timing, the property, the borrower, that you really need to have kind of like a comprehensive look at the entire picture. And then one thing that we haven't even talked about, which is why a mortgage broker I think is so valuable, is the appetite of the lenders at specific times, right? Because a pension fund might be more interested in, I'll just let you talk about it, but they seem.
I think it brings up, there's a couple of good points there. I think the one is, you should assume that you need a guarantee.
Yeah.
But that draws another reason to bring, the debt side in earlier. Because if you're looking at a property and you're saying, hey, I think this is great.
Yes.
I think I can get away without any personal guarantees or any guarantees.
Yes.
You should get that perspective early. There's no point in tying it up and going through all of that work and the cost associated with it.
Yeah.
If it's a faint hope.
Right.
That the market's going to be there for you on a non-recourse basis.
Yeah.
So I think that's another reason that's about determining what your needs are. It's not that it's necessarily wrong to say, I don't want to provide a guarantee.
Yes.
You just have to find the right opportunity for that.
Right. Yeah. Yeah.
And so I think that's another reason to get into it. And then I think the other one too is, and this is maybe diverging a bit, but you have to think about your timing.
Mm-hmm.
So I know you're keenly aware of what gets set out in a purchase and sale agreement. That's a contract, and there's certain timeframes, and they don't always line up. The expectations of a vendor that wants to sell a property don't always line up with what the debt market can deliver.
Yeah.
So we always look at it and we work backwards. What's your closing date?
Yeah.
And if your closing date is, the 15th of the month, well, 30 days is probably that's a reasonable time frame in which to close a deal.
Yes.
But that needs to be 30 days from when you waive conditions.
Correct.
So there's 30. Now you go back and you say, okay, well, how long does it take me to satisfy all my conditions? And if I'm thinking of financing,
yes,
a lot of lenders are 3 to 4 weeks to approve and issue a commitment letter.
Right.
And you need time to negotiate that and sign it.
Yeah.
So if you work, now we're thinking it's 60 days. And
for due diligence. Oh, for
well, it's the due diligence period.
Yes.
Your financing has to run in lockstep with that.
Yeah. Yeah.
So now, how far in advance do you have to start that process?
Yes.
So that you can take your deal either to a lender directly that you have a relationship with, or through a mortgage broker to the market.
Yes.
How long do you need to expose that to the market, solicit interest, get an application letter that you're happy, and then that's when the lender, you've chosen a lender, and they start their commitment process. So, unfortunately, this component of commercial real estate is, we sort of jokingly say it's still a bit of a dinosaur. It's still paper intensive. Decisions are made in layers.
Yes.
And often they're approved in different cities.
Right.
So I would say, I don't think 90 days for due diligence I don't think 60 days for due diligence plus 30 to close. I don't think any vendor or agent's going to be happy about that.
Yeah.
But you have to give yourself as much as possible. So maybe it's 45 and 30.
Yeah.
But again, that goes to your needs.
Yeah.
Right?
And there's multiple ways to position that in a purchase and sale where, let's say you remove all conditions subject to financing, for example,
Right.
or, I mean, yeah, that's really where having a good understanding and a grasp of commercial real estate investing is, I think, important because, up until the point that you remove your conditions, you still have an element of control in the deal, if you will, right? You can walk
Yeah.
away if you've shown the vendor and the agent that you're doing everything you can, and you can demonstrate, hey, I've got my commitment letter, but it's not satisfied yet, right? I mean, there's different ways to kind of spin that, if you will, because in a hot market, you might get 30 days, right? And so you've got to, but that's where you can kind of play with the LOI a little bit. And to your point, if you've got your team, on day, T minus 10, like 10 days before you get a purchase and sale, you can get some of that work done up front.
And that's why, like, if you discover a property and you sign a CA and you get a rent roll and things, there's no harm in having, a group like ours come in and underwrite it. Totally. Because you'll get a real quick answer on, okay, these are what my expectations are for debt.
Yeah.
And I mean, the market's the market.
Yes.
It often proves us wrong in terms of, you find a lender that's a little bit more competitive because they have, a need for that product type, or they have a year end coming up. And so, I know you'd mentioned sort of pros and cons. I mean, we always look at our role as adding value.
Right.
So if we can add value to the transaction, we'd want to help somebody or provide somebody with some advice.
Yes.
But there's not necessarily a role for us to play. We do think on many transactions, we can add a tremendous amount of value.
Yes.
And so, when you have a relationship with a bank or a lender, we're never looking to replace that. Yes. I think the difference you have to consider is if you go to your bank, you're getting their view on that deal at that particular point in time. Using a mortgage broker, you're getting the market's feedback on how they view the deal. And our experience is competition, 99% of the time will beat a one-off offer.
Yeah. Yeah. No, I think there's tremendous value having a mortgage broker. And I mean, there's a reason why the companies that we know that you deal with continue to go back and use you. I mean, it's not that they don't have relationships with banks already. I mean, a lot of these guys have, huge lines of credits and they have relationships with multiple banks.
Yep.
But there's the actual, getting the terms and the pricing of the debt, if you will. But then there's just the amount of like energy that goes into and the due diligence. And I mean, having a mortgage broker almost like, I don't want to say it takes care of it, but it keeps a buyer on track and make sure that they don't miss anything, because the bank is going to have more, at risk, if you will, but the bank isn't going to teach you how to do the deal. Whereas a mortgage broker is going to kind of hold you by the hand and make sure that you've got all your ducks in a row at the right times, and helps with, property due diligence, legal due diligence, physical due diligence, all that kind of stuff. So,
yeah. And I totally agree. I think that, one of the things that we pride ourselves on is moving through transactions start to finish.
Yes.
Our interests are aligned in that, we don't get paid until the funding happens.
Yeah.
So obviously there's some, I would say there's some selfish motivations to closing the deal, but it has to be done properly. Yeah. So you can't cut corners, you can't make assumptions, because we've been through the process enough. And I think that's part of the sort of, some of the value we bring is we're in the debt market every day.
Yeah.
So you don't have to be.
Right.
And that's why, we have clients that have the relationships and they have the ability or expertise. This isn't rocket science, but there is a tremendous amount of experience and relationships on the lender side that we, I think, bring into the transaction. The other thing that is important, for some clients, but not all, is let's say you have 3 partners,
Yes.
and you are charged with going and getting the financing. I think you can say to your partners, where the deal's been exposed to competition through the market, we have the best deal for us, versus this is single sourced. And so, for some of our clients that would be, pension fund or public markets driven, the corporate governance side is huge for them.
For sure.
Because they have, reports and presentations all the way through that say, here are all the different lenders that were.
Right.
Because I think that's one of the misconceptions, is there's not a magic source of capital.
Yeah.
I think any buyer with some work can find the lenders out there.
Yes.
But I guess I look at it and say, well, why would you spend your time there when you can either spend it on, what you do for a living,
Yeah.
if you're not a real estate investor full time, or if you are a full-time investor, the rest of your portfolio, or getting the rest of the deal done.
Yeah.
So it's a delegation thing, and obviously I've got some bias, but I think there's a role to play on many of the transactions out there.
Yeah. What would be maybe fees that someone could expect when they engage a broker, right? Like upfront commitment fees, standby, you know what I mean? Like some of those kind of numbers, even for me, I've done a lot of transactions, sometimes it's almost like it sneaks up on me and I'm thinking, oh yeah, I forgot about that. I need to bake that into my deal up front to make sure I'm accounting for, you know.
Well, I mean, you've got so many costs that come up when you're financing or when you're buying, I guess, because you've got the physical reports. These are all due diligence costs, legal. Yeah. We're based on, we're performance driven.
Yes.
But what we do is when we establish your needs, we then issue a mandate letter or an engagement letter. Yeah. So our fee is understood right from the start.
Yeah.
We're typically a percentage of the loan amount. Mm-hmm. Oftentimes a buyer or a borrower will have the fee come out of the proceeds of the loan. But, so that's a possibility. That's the way that legal fees get paid. But some, larger institutions often like to see the flow of checks, and so all that's fine. So I would say, again, it depends on the transaction. Yeah. If you're looking for second mortgage debt or, something high leverage, or it's just a difficult structure.
Yes.
You're on the higher end, but I would say generally you're probably in that 50 to 100 basis point range for fees.
Which is 0.5 to 1%. Because you and I, we talk in basis points, but
that's
that's okay.
And then with a lender, if you're doing term debt, so 5-year fixed rate debt, or 10-year, whatever, you're probably, I would say 20 to 40 basis points is what a lender will earn, and that really varies on the type of lender.
Yeah.
And those are all negotiable. And then when you are in a process where you're buying a property, you're committing, and then you have a period like that 30-day close period, some lenders will allow you to set a rate early.
Right.
And even in the absence of that, a lender often collects a refundable standby fee, because once that commitment's signed, they want to make sure that you're going to continue down the path with them. They've often set aside money, so there's real cost to the deal collapsing for them.
And when is that? Is that when the commitment letter is signed and sent back to the lender? Is that that point you're sending them a check for?
Correct. And it's usually 1% to 2% of the loan amount. It's refundable, but that's something that is an out-of-pocket cost for that 30 to 45 days.
Right.
Yeah.
Yeah. And I think that's really important for kind of new investors to understand, is that, in commercial financing, it's taken very seriously, where lenders, if they're essentially counting on that money to go out, they want to have some skin in the game from the purchaser, if you will.
Yeah, it's called for a reason, right?
Yeah, exactly. Okay, so and then maybe just kind of like, I know what you mean when you talk about it, but maybe just kind of describe like setting rate and when that happens, because I think if you're not familiar with it, like when you, if all you've ever done is kind of residential lending or borrowing, right, generally the banks kind of say, well, it's 3.8% or what, like they just kind of, but with commercial, typically rate set doesn't happen maybe the day of, or you can pay a premium to have deal certainty, but you're going to pay for that. So maybe just touch on that a little bit.
Yeah. So, I mean, it varies widely, depending on the type of lender, but so let's assume that you've signed a commitment letter, because that's generally speaking, that's when the first point at which you could consider setting a rate, depending on who your lender is.
And maybe just, sorry, Kris, what is a commitment letter for someone that doesn't know what that term means?
That's your contract. So that's where you've chosen a lender. The lender goes, they get a deal approved, and they come back to you with a contract that says, we are willing to finance this property. Here are all the terms.
Yes.
Here are all the conditions you have to meet.
Yes.
And here's the time frame. If you meet all these conditions, we will fund the money to you.
Yes.
Okay. So it's your contract to finance, essentially.
Yeah. Okay. Good.
So in the simplistic scenario, a interest rate for a commercial mortgage could often be set at the day of funding.
Okay.
And so generally speaking, commercial mortgages, the interest rates are structured or set over a Government of Canada bond. So if you're doing a 5-year term, the lender will, and you'll see this in the commitment letter, this is all transparent, but the yield on the 5-year Government of Canada bond is, we'll call it 2%. It's much lower than that today, but let's call it 2%.
Yeah.
The lender earns their money through a spread. So that's the risk premium. So they will say our risk premium is 1.5%. So you add those two together, you get a 3.5% rate.
Yes.
So when you sign the commitment, the piece that shouldn't change, the lender's committed to, is that risk premium.
The spread.
Yeah. What can fluctuate between the day you commit and the day you set an interest rate and fund is that Government of Canada bond yield.
Right.
It moves, trades every day.
Yeah.
So the 3.5% that is, quoted to you as an indicative rate when you sign the commitment, it could end up being 345. It could end up being 370.
Yeah.
There's movement that can happen. Yes. So that's how your rate gets set.
Yes.
In a more detailed manner, you can encounter a credit union that just says, we're going to give you a whole interest rate. We're not telling you how it's done,
right,
but if you like that interest rate, we'll set it at something in that range, at the day of funding. Now, behind the scenes, what they're doing is they've got a cost of funds.
Yes.
And it operates in a similar manner to a Government of Canada bond, but it's not transparent.
Right.
And they also add a risk premium to it.
Right.
So, and now if you get into a scenario where a lender allows you to set an interest rate in advance of funding, which is very common, often, certain life insurance companies are quite good for this. They will allow you to set it 30 days prior to funding, often and with no cost.
Oh, really? Okay.
Yeah. So then you're protecting both the movement and your exposure to movement in the Government of Canada bonds,
right,
and the premium. So you can choose to set that.
Yeah.
Now, the thing you have to remember as a buyer is once an interest rate is set, all of a sudden there is a real cost. So if you get through and you discover something, after you've committed to the loan and presumably waived all your conditions, and you don't close, there's actual cost to unwinding that interest rate. So
would that be over and above the standby fee?
It could be. Yeah, it could be. And there's language in that commitment letter always that will say, we reserve the right to go out, to go after a borrower if the costs are more than that.
Yeah.
So I think, one of the things that we always work with on our clients is you're mindful of where that interest rate is, because movement in that up or down costs or saves you money on the transaction. But you also have to be comfortable that, in a situation where you're not buying the property, you're refinancing, you may not have the environmental report as an example.
Right.
And so if the environmental report came back and there was an issue, it can delay the transaction. So you have to be, I think, reasonably comfortable with where things are in the entire process.
Yes.
To set rate.
Yeah.
If there's anything that could cause a delay, we often talk with our clients about, should you take more of a measured approach? Should we wait for that to happen before we set the interest rate?
Yeah.
And that's deal by deal. And it's not meant to scare somebody, but I think it's something that, towards the end of the commitment letter, when you're tired of reading a legal document, that's when those clauses come into play, and you really do have to pay attention to that. That's why your lawyer should also read it with you.
Yeah, no, fair, and you're right. And a good commercial real estate lawyer will go through that in detail. However, in my experience, when you're paying a lawyer $600, $700 an hour, if you want to sit down with him and go through, like, what is a commitment letter these days? 20 pages, 30 pages long,
Yeah.
right? And so for you to sit down and have your lawyer explain it to you, that might be a pretty, which is why a broker is so valuable. Not to say that your time isn't as valuable, but you know these commitment letters so well, you can kind of pick apart, I suspect, that a person really needs to focus on. Where in my experience, lawyers are there to protect you and kind of scare the hell out of you a lot of times, right? Which, unfortunately, if you're new to it, you may never do a commercial deal because you would just be paralyzed by fear. Where having a mortgage broker say, well, look, this is standard. These are the things, and as long as you do X, Y, and Z, you're kind of you'll be okay.
Yeah, and that's part of what we do with a client is, we're not getting paid by the hour, but we've read all these commitment letters by and large, numerous times, so we know what to look for. And if you're new to the process, we can say to you, listen, this is what this means.
Yes.
Practically speaking, this is how it should work.
Right.
Here's your downside.
Yeah.
So that interest rate is a perfect example for someone new to the process.
Totally.
You can say to them, this is how we set the rate, and we can set it on this day. But know that these are all the combinations that can happen afterwards.
Yeah.
I think the good thing in an acquisition is you really should have covered off, not all, but most of the surprises that show up on the due diligence.
Yes.
You've been through all that. You've waived your conditions. You're comfortable with that.
Yes.
We want to be with the client all the way through. There's never a point where we are hands off.
Right.
So we're trying to be, your bolt-on CFO or your, financial advisor all the way through from start to finish.
Yeah. One of the questions I wanted to just run through with you, because I think that this might help people that are new to investing in commercial real estate, or even seasoned people for that matter, is like, are there like mistakes that you see either new or sophisticated investors making as it relates to, I know one with a mutual friend of ours, Brett, when I got some commercial financing from TD back in the day, I waived my financing conditions before I actually had an approval. That put a tremendous amount of stress on him and me. But I'm just curious, like, what other mistakes do you see or areas of risk that someone should be aware of?
Yeah, so I think early on in the process, so when you have, let's use a scenario where you're working directly with your bank.
Sure.
So one of the things that you should understand is, well, how long does that approval process take?
Mm-hmm.
And what are those steps? So there's very few local offices in any lender that have an approval limit. So if you're dealing with, a big five bank or life insurance company, there's a local person, an originator that is going to structure the deal.
Yeah.
You sign an application letter with them, but if it takes 4 weeks to get an approval, does that work inside of your due diligence period? Unless
and on that, I just want to make sure people understand that an application is far different than a commitment letter. An application is really just the
letter of interest.
Like a letter of intent. It's just a very basic, here's kind of broadly speaking how this might look, but we're far from.
And it's non-binding.
Non-binding.
For both parties.
Okay.
So it's the intent to go and get it approved, and we think we can approve it on that basis. So I think that's one, is not making an assumption on how quickly the lender can or can't approve.
Yes.
And there, I mean, there's detailed nuances of that. We had a scenario in Alberta where, with credit unions at a certain dollar limit, they would go to this. It was the Deposit Guarantee Corporation, and if deals went there, they weren't real estate people, they weren't risk people, they were. So we found a couple transactions when it went to that level.
Yes.
You would get deals changed or coming back with questions, and it was very frustrating for a borrower because these questions weren't rooted in commercial real estate. They were rooted in oversight and not a real understanding of how the transaction worked and what the positives actually were. So that's a good one.
And on that, you might burn up 2 weeks before they have that meeting, and then they come back to you with all these questions, and you're 2 weeks away from removing conditions. And if you're committed to that credit union, now your back's against a wall, right? Either you're going to have to cave and put in more money, or, I mean, there's just so many things that can happen if you're going down the wrong path with a commercial lender, if you will, and you don't really.
And I think we have to be aware of that. So like, here's a great example. So yesterday we were chatting internally, we had an offer on a larger deal. Yeah. And my partner said, well, does that have to go to that regulatory body? So this is a credit union that had they issued a letter of intent. And so I went back to them believing that was the case.
Yeah.
And they clarified, they said, no, we don't actually have the deposit guarantee involved anymore. It's all done internally. So that gives me a more of a comfort level, saying to the client, we understand where this process is going to go. There's no longer a black box that it enters, and a time frame that we can't control.
Yes.
So I think the timing, or not making false assumptions on timing. One of the due diligence items that comes up a lot is when a vendor comes with the physical reports, so a building condition or an environmental site assessment.
Yeah.
And there's often, and I understand this, there's often a desire for the buyer to say, well, these reports say this, or let's use the environmental. The consultant says the property's clean. Yeah. Can we just use these reports? And I think the misunderstanding that comes up there is, if you haven't commissioned the report, there's very few engineering firms that will allow either yourselves as the buyer, but more importantly, allow your lender to rely on that report.
Yeah. Yeah.
And a lender, it's gotten so, it's such a sensitive topic that almost always a lender has to have a report that they can rely on. And that's a reliance letter that's written by the engineering firm, and it grants that reliance. All these letters now are approved through legal components of these engineering firms. So it's hugely important. And the other thing too is, if the vendor has had the property on the market for 6-8 months, they got the report 12 months ago, lenders often can't accept a report that's older than 12 months.
Right.
Some even tighter than that. So I think that's one that comes up. I can understand certainly wanting to save the money on those due diligence costs.
Yes.
But by and large, we say to our clients, updates aren't going to work. Except, using a vendor report isn't going to work. You can see that and take comfort in it.
Yes.
You can't use that for fun.
You can't rely on it.
Yeah.
And I would even say, I just remember my days at Sun Life, sometimes you'd have kind of a new investor come in, and they're using some consultant you've never heard of that may not have the sufficient insurance, right? And so now all of a sudden they've spent $3,000 on a environmental or a building condition report, and you're looking at it saying, well, no lender's going to touch this, or you can't use it, right? You got to go and get one now from a more reputable company. I have to think that's just as you were saying that, I was thinking, because I do remember a deal where that happened. And
that does come up. It's a little bit frustrating because lenders don't often have approved lists of consultants.
Right.
Some do, but most don't. But intuitively, they know, well, yeah, if you don't have the requisite insurance, or, I mean, you don't have a name or experience behind you,
Yes,
it's more difficult to use those for the financing.
for sure.
Financing is often a frustrating but a valuable check and balance on the acquisition process.
Yeah, yeah. The way I view it when I'm working with, especially like a tier one bank or lender, not the private guys, because they're more concerned with how much money are they going to extract out of you in a short period of time.
Yeah.
But if you're going to like a conventional lender, I really view them as like second checks and balances, if you will, to make sure that you're not overlooking something.
Yeah.
So on that, are there checklists? Because I want to be sensitive to your time. I know you probably have a lunch coming up. What is there anything that you provide to your clients as it relates to like checklists or
I mean, I don't know if we have, our closer has a checklist that she goes through. It's modified based on the type of transaction. I mean, a construction deal is much different than acquisition.
Yeah.
I think generally what we try to do is, early on in the process, through the mandate letter, we try to alert the borrower to here's some of the things that we notice, looking at the property that come up as, sensitive. You should be aware of this lease or, these things. But we're doing due diligence alongside the borrower. So we do lease reviews internally. They're not used, they're not the legal side of it, but we do that for our own purposes.
Yes.
We're thinking about, have you agreed to a form of estoppel? So yeah, there isn't a checklist or anything that I would sort of point anybody to specifically that we hand out, other than we're trying to structure all those deal points up front. And it kind of depends on what the transaction is.
Yeah.
If it's a refinance on a property that the client's owned for 15 years and we've worked on it, it's probably a little bit more seamless, or a little bit less detail oriented.
Yes.
But a property that you financed 10 years ago versus today, even if it's the same deal, even with some of the same tenants, it's always different. The market conditions are different. So there's very little repetition.
It is very deal specific.
Yeah.
And so you mentioned construction. This is more of a personal question for a deal I'm kind of considering right now. I guess question number one, do you work with CMHC to do CMHC type financing?
Yeah. Okay. So the insured financing for multi-unit residential. Yeah.
And then on new construction with, say, purpose-built rentals, do you like the property I'm considering right now is mixed use? So you're going to have a certain amount of retail on the ground floor and then multifamily for rental up above.
Yeah.
Is there any important things to take into account with respect to the percentage of retail on the ground floor? And I mean, I know it's probably a big question, but I'm just
there's a specific answer, and I'm just trying to remember the ratio. But it's two pronged. So your retail,
yes,
or let's say your commercial use, you can get debt on that, and it's almost like you have to divide it into two different properties.
Oh, interesting.
So you can you can get up to 85% of value.
Yes.
On the multi-unit residential side.
Yeah.
You max out at 75% for the retail side.
Gotcha.
But you're still subject to different debt service coverage ratios.
Yeah.
And then they look at it and they say, overall, you can't be more than, I think it's 30%, but I mean, they have guidelines that are very straightforward.
Okay.
You can't be more than 30% of the net rentable area and the income.
Gotcha.
So there's a lot of different checks and balances, because CMHC is not, their mandate is for rental.
Yes.
And their expertise is not in commercial.
Right.
So you can do it. I mean, we've done a couple of those, and they've worked out quite well.
Yeah.
But you have to be, again, you can't make assumptions. The guidelines are fairly clear, and there's very little room, but there's some gray area. But those are ones that, like, if you're looking at something, it's easy to sort of underwrite that in a mixed use model.
Yeah.
Kind of give you a sense of, okay, here's what it could look like from CMHC's perspective.
Yeah, perfect. You brought up a concept, debt service or debt coverage ratio or debt service coverage ratio. I think that's such a, like you and I, we take it for granted because we talk like that, but maybe just kind of quickly explain that concept, because I think it's so critical for an investor to understand.
Yeah. So, I mean, simplistically, it's the ratio of your net income,
Yes.
so your annual net income over your annual debt service cost.
Your mortgage payment.
Yeah. The annual mortgage payment. So your monthly P&I wrapped up in a 12-month.
Gotcha.
Number. And lenders, so in addition to looking at a loan to value, they also say, well, you have to go into this transaction at a minimum of, I would say, 1.3 times.
Okay.
So you have to have, annual net income that is 1.3 times better than what your
the mortgage payments
are.
Yes.
And, so often, one of the questions is, well, can we get 75% loan to value? You might be able to get that,
yeah,
but the debt service often doesn't allow you to do that.
Right.
So there's a couple of different checks and balances, and
yes.
and that's part of, when someone's looking at a property and they're saying, well, I only want to put 25% equity in.
Yeah.
We may be able to find you that, 75% loan to value. But if they also say we need 130 times coverage, debt service coverage,
yeah,
and there's under market rents, it's probably why you're getting a good value.
Right.
But you just may not have the income to get there yet.
Yeah.
And so that brings into a scenario where do you want to go in with a short-term acquisition loan? It gives you a chance to add value, bring the rents up, and then you look for your term debt. So there's all those things when you're looking at a transaction that, again, coming back to your needs and the characteristics of the property. I mean, it's easy for me to say, well, I can find you 10-year debt, but if you don't want it, right, the property doesn't make sense to do it, I'm not adding value to that. We need to come in and say to you, maybe this property isn't quite right for fixed term.
Yes.
Maybe you need a transition loan or a bridge loan to make some changes.
Yeah. And see, I'm glad that I totally forgot to even kind of touch on that. But one of the big things I focus on is value add. And so I'm typically finding a property, and even the clients that I work with, that might have an issue with it, right? Under market rent, some vacancy, they've got to reposition it. And so to secure 5-year money or 10-year money probably isn't in their best interest if the idea is that you're going to add value and maybe pull some money out or top it up down the road. So right. Having a mortgage broker that really understands your options, and every lender is going to be different, right, in terms of how they look at that, and you might go to one lender here and then another lender over here once it's stabilized. So yeah, okay, that's great. Well, is there any places that like, I'd like to give you an opportunity to kind of if someone's interested in using Miller Foreign for their commercial financing, where should they go? What should they do to kind of engage with you guys?
I mean, I think it's our website is fairly simple. millerforeign.com.
Yeah.
Relatively instructive in terms of the type of deals we work on.
Yeah.
It'll give you a sense of who we are. Very easy to contact you, and pick up our phone number that way too.
Yeah.
But yeah, I mean, I think we're open for a conversation. It always starts with that, and we've found that while this is we're talking about a transaction, we're very focused on relationships.
100%.
And I think that's the bigger part for us is, many of the clients that we work with are long-term relationships, and we're always looking for new relationships, new owners, developers. But we want to establish that relationship and not just have it be transactional. Yeah.
It's interesting. And I think that investors coming from the residential world that is very transactional, and sometimes using a new agent and a new whatever, like the team kind of seems to transition a lot on the residential side. in the commercial world, what you find is it is so relationship driven that, I mean, you know, you and I, right? I mean, I just pick up the phone on a Saturday or a Sunday and I'm just like, hey, Kris, I'm thinking about this, or I'm looking at this deal. And you get back to me without, obviously if the deal comes together, then, you know, everyone's happy. But a lot of times it's just getting that kind of initial feedback to determine whether or not it's something that you want to pursue, and having someone you can trust that's not going to BS you into, you know, because commercial is such a long-term big investment, and your reputation is so key that, you know, yeah, I can't say enough about it. So it's one of the reasons I really wanted to have you on today. And I really appreciate you taking, you know, the last hour to kind of run through this with me, because I think my audience is going to get tremendous value. And yeah, so thank you.
Yeah, it's been a lot of fun. And if you know, questions come back to you,
yeah,
you know, happy to answer specific stuff that's coming up for people. But no, I appreciate the time. It's been lots of fun.
Okay, perfect. Well, thanks, Kris.
Okay, you bet.